The Chicago presentation of Wall Street Week is brought to you in part on behalf of Steinrow Mutual Funds, where a world of investment opportunities awaits you. Whether your investment goals are capital preservation, tax-free income, or long-term growth, the Steinrow family of commission-free mutual funds is ready to help.
Wall Street Week with Rukeyser is made possible by the financial support of viewers like you. By the Travelers, insurance and related financial services working to provide financial peace of mind for American business. By Enron, providing natural gas which holds the promise for a cleaner world and a more energy-independent America. Enron Corp. And the Enron Foundation. And by Prudential-based securities. Rock solid. Market wise. Produced Friday, November 2. Our panelists are Eddie Brown, Carter Randall, and Robert Stovall. Tonight's special guest is Richard H. Jenrette, Chairman and CEO, the Equitable Life Assurance Company.
Good evening, I'm Rukeyser. This is Wall Street Week. Welcome back. Well, this was the week when George Bush announced that he would be spending Thanksgiving in Saudi Arabia. It is not true, however, that the president will be traveling 8,000 miles as part of his worldwide search for his lost economic policy. A highly informed White House source told me that such reports were scurrilous and untrue, and furthermore that they did not help Mr. Bush in his effort to locate his economic policy, which has to be around here somewhere. Meanwhile, back at the economy, things are definitely weakening even before the latest tax increase hits in January. For one thing, and perhaps the least surprising news of the week for the average American household, a lot of people have started spending more money than they're making. I realize that this intelligence may not exactly knock your socks off, but now it's official. Consumer spending rose more than twice as fast as personal income in September. And the great 1980s job-creating miracle is clearly petering out. While the official unemployment rate was unchanged in October at a 3-year high, actual payroll jobs tumbled again, and the average factory work week shrank. Nor was the big picture anything you'd want to hang in a museum. The government's index of leading economic indicators declined for the second straight month. 3 in a row is supposed to be a definite recession signal. Construction spending took its worst hit in nearly 9 years. The purchasing manager's report said buyers were nearly as scarce as politicians who kept their promises. And the Federal Reserve reported gloomily that economic activity was softening in nearly every area of the country. Is this a recession yet? Well, folks, it sure ain't a boom. One of the few bright spots of the week was an unexpectedly strong report on third quarter gross national product, which said the nation's total output of goods and services actually grew this past summer at an annual rate of 2%. Anyone who took that report too seriously, however, is probably an excellent candidate to purchase the Brooklyn Bridge. For one thing, its inflation component did not reflect the impact of the soaring oil price, and even White House economists acknowledged that the U.S. economy is likely to get worse before it gets better. But the report did cast doubt on those who insisted the economy was already in recession before Saddam Hussein got nasty. The Baghdad bully continued to cast his shadow over all the financial markets, but as the week ended, a lack of either war or peace rumors helped the oil price to stabilize at $34 a barrel, and this in turn encouraged bond traders to emphasize the good news of moderate monetary easing over the fears of inflation that had been torpedoing bond prices earlier this fall. And stocks followed suit, with an upward move on what has lately been a seesaw around the lows for the year. Perhaps investors took heart in the knowledge that with Congress finally adjourned, it was no longer necessary to remember the counsel of Will Rogers, that when Congress is in session, no American is safe. We tonight will look at one of the most troubled industries in this troubled economy and talk with the boss of one of the nation's largest insurance companies. But first, let's check the latest policies on Wall Street. The Dow Jones Industrial Average, which had a big gain 2 weeks ago and a big loss last week, swung up a bit this week, though still without much volume or conviction. For the week, the blue chip index added nearly 55 points to close at its best level since October 24th at 2490.84. And though the oil-heavy American exchange continued to lag, most broader indexes joined the latest mild upsurge. None of which impressed our 10 chief elves one way or the other, and their technical outlook for the next 6 months continues to net out at a mildly bearish -2. Precious metals turned in minor gains for the week, while the dollar was mixed. And if all this is making you sick, it may depend on your sex. A survey reported this week said women find the aches and pains of a cold more miserable than men do, but that men more often blame themselves for catching a cold, while more women are inclined to blame external causes, a difference which in this faltering economy may be nothing to sneeze at. Bob Stovall, when is this market going to get well?
I think we're in a bear market, Lou, and I think we're in a rally in a bear market that might excuse me, that might last for a few weeks, but I think it might take several months before we start to see a really definite change in direction.
What would change the direction?
I think you'd have to see perhaps the market prices drop lower. Usually bear markets don't end until the yield on the average stock, the Standard & Poor's of the Dow Jones, gets to about 5%. That would take you all the way down to 2,100 in the Dow Jones if it got that bad. Also, you have to see a passage of time where the Federal Reserve Board is able to reduce interest rates to a point where it revives consumer spending again. Of course, we'll get evidence as we get through the next month or two, get through the holiday season. But I think it require more time and more damage.
One of our panelists last week said he thought we'd be lucky to escape with a severe recession. Is your outlook that dark?
No. No, I don't even think we can really say we are in a recession right now, because I treat recession somewhat like pornography. I'm not sure of the definition, but I can recognize it when I see it. And in most activities, major activities, it does look recessionary.
Are you an authority in those two areas?
I'd sooner you pass to Eddie on that one, thanks.
Ed, I won't ask you about pornography, but I'll ask you about this filthy economy. What do you make of it?
I think it's about time maybe to start thinking about the unthinkable, and that is the possibility that we may not have a recession. I remember very distinctly after the crash in '87, almost everyone and his brother predicted a recession was on its way. Never happened. I think perhaps this time we might end up with a mild recession, but I think if we get a few things breaking right, I think we might get this economy back on track. For example, if interest rates around the world began declining, as some of them have begun already to do, and if the Federal Reserve then would have more flexibility to ease more aggressively, we had a modest easing, 0.25% this week on the Fed funds rate, I think that can really put some life into the economy and into the market. So I think you should be doing what I call shopping now for a salvage and recovery portfolio. Some stocks that have just been beaten unmercifully, companies will still be in business, and if you can put them aside maybe for a year, year and a half, I think people can make a lot of money.
Well, be our junk man. Tell us where to look.
I think one area would be the battered savings and loan stocks, some of the battered bank stocks, but the ones that will survive. And I think it might be too early, but I'm saying let's start putting a package together.
Can you name 2 or 3 of those?
Well, I think a company like Golden West will make it through unscathed. I think maybe Great Western Financial, maybe Amundsen are good quality companies. I would want to wait a little while yet, but I would start putting a package together.
Before I leave you, because your relative optimism is refreshing, you think that we will have lower interest rates, as a result of which we will not have the severe recession, and that we will be recovering a year from now. Is that basically right?
That's correct. I think also the retail stocks is an area that's been battered that one can put a package together.
Carter Randall, how do you come down on that?
Well, I'm very close to Eddie. I think this is going to be very short-lived, not a deep recession. It's led by the real estate sector. But I'm very bullish on one thing, Lou. I'm bullish on bonds. I think people who are would-be buyers of bonds should have bought them yesterday, and if not yesterday, Monday morning. Interest rates are going to go down a lot more than anybody thinks. The Fed is easing, inflation is going to be coming down, and so too can interest rates. And that could really re-stimulate the economy. You know, there's $500 billion in money market funds which will flee to the longer markets when the rate of return on those short-term funds goes down, and they'll flee to the longer market.
Well, let's talk about the mechanics of this proposal. You're talking about government bonds?
Well, I'm talking about government, corporate, or tax-exempt bonds. For most investors, actually, I think tax-exempt bonds are the most attractive, because although after taxes they yield about the same as taxable bonds, income tax rates are bound to keep going up, and a dollar's worth of tax-exempt income will be worth more in the future than it is now. I'd buy the 10 to 12-year maturity bonds. I'd own them with a high heart. Stocks, I think it's time to well, I've been saying it, keep nibbling at stocks. We're going to have a rebound in the economy and the stock market before that happens, so I'm not worried about the stock market.
All righty. In any event, it is time now to give our viewers something to be thankful about this November. Bob Stovall, William E. Fisher of Sacramento, California, says his investment philosophy is simple. Buy quality stocks in well-managed companies that have a record of increasing their dividends and hold the stocks for the long term. My problem, he writes, is how to locate these stocks. Is there some reference that is easily obtainable as well as understandable to someone outside the brokerage business?
No, there sure is, and by the way, I agree with him. The great fortunes are made by finding good companies and staying with them. First of all you've got to do is find someone with a computer who can just say call up the utility stocks on his screen. There are about 10 utilities that have raised the dividend every year for at least 25 years. The 3 Wisconsin companies, the 2 of the big Florida companies, Louisville Gas and Electric and Hawaiian Electric. That's pretty easy. Going further afield, it's not hard to find similar lists published by the big rating services, Standard & Poor's and Value Line. Most libraries would have the Standard & Poor's monthly guidebook, and you just look for every A-rated stock in the Standard & Poor book, and there are about 75 of them. Companies like the check printers, John Harland and Deluxe, and the tobacco companies, UST, Philip Morris, some paper companies like Kimberly-Clark. They have long records, 10-year records of dividend increases and strong earnings. Value Line has a similar type of a service.
All righty, Ed Brown. Albert Hyman of Boca Raton, Florida, was impressed with the higher interest being paid on 90-day Canadian bills as compared with that on U.S. Treasury bills. But when he tried to buy some, 3 leading brokerage houses and 2 big banks all told him they didn't handle these securities for small investors. He'd like to know where he can buy Canadian government securities.
I think the fact is the brokers don't make too much money, and that's probably why he got that response on small transactions, unless there's something else to follow. There are at least 3 firms that he should be able to go into any office anywhere in the country and do the transaction: Merrill Lynch, Payne Weber, and Dean Witter. There may be others. What he has to remember, though, is that even though it's currently around 11.75%, say for a 6-month Canadian T-bill versus a 7.3 for a U.S. bill, there's a currency risk and there's a conversion cost. For example, if the Canadian dollar weakens by 2 cents, that 11.75 becomes an effective 8.25. There's about a 1% conversion cost to buy and sell Canadian dollars. So therefore, you'd be about even. Of course, the currency can go the other way, but he shouldn't forget that risk.
Will you repeat that in French for our Quebec viewers?
Parlez-vous.
Carter Randall, how would you respond to Laurel Bloom, who wrote me on behalf of the senior economics class at Alliance, Nebraska High School, which she says enjoys watching this program every week? Apparently, she says, because of education and other reasons, perhaps including soon-to-be higher sin taxes, smoking, drinking, and some drug use is declining in the U.S. Are there any investment possibilities here, such as rehabilitation centers or substitutes for drug use, such as nicotine gum? Incidentally, she adds, we are high on your program. Keep smoking them on Friday nights. Wow. You better watch that stuff, Laurel. One thing we do not tolerate around here is punning.
Well, I'm not going to pun. I'm going to answer the question. I agree that this is an area for investment. The major hospital management companies have beefed up their psychiatric care facilities very much, but the one company that I have liked for a long time still do is community psychiatric centers. One of its big fields is substance abuse types of problems, and I recommend that stock very highly.
Okay, no guarantees from the management, but if you are looking for economic rehabilitation, we'll drink to that, in Sody Pop, of course. So to help your financial life get healthier one day at a time, shoot your cleanest, straightest money questions to us here at Wall Street Week, Owings Mills, Maryland, 21117. That's Wall Street Week, Owings Mills, Maryland, 21117. Now, before we meet tonight's special guest, who heads one of the nation's largest, and to at least some analysts, sickest insurance companies, let's focus on his giant firm as an example of how the life insurance industry itself has changed in recent years, from a hardy, if relatively colorless, perennial, to a more troubled life as a tree with many branches. Industry analysts tell us that the Equitable tree could use a whole hospital full of doctors these days. The traditional individual life insurance branch has seen profits come down sharply over the past 4 years, and analysts say the group health and individual annuity businesses are faltering too. As for real estate, some analysts believe that what they see as Equitable's overly aggressive investment posture in properties and mortgage loans has exposed the firm to high risks. The guaranteed investment contract business of the late 70s and early 80s, under which the firm promised to pay sky-high yields, has reportedly already lost Equitable more than $1 billion. And the investment yield of the nation's third largest insurance company, which is owned by its policyholders, is down to 8.11%, as compared with the industry average of nearly 9.5%. Surveying all these heavy limbs, one industry analyst told us bluntly that it was, as he put it, unusual to see a company that has so many problems in so many different sectors. Is this $62 billion financial colossus really in such deep trouble? And if so, what does it mean to you? For some thoughts on that, let's go over now and meet tonight's special guest, Richard H. Jenrette. Dick, welcome. We're very pleased to have you here tonight.
Thank you, Lou.
Please have a seat.
You said we're going to have fun with that introduction.
Oh, sure, we're going to have fun. It wouldn't be surprising if Richard Jenrette occasionally did feel like the fellow in the Alka-Seltzer commercial who said, "I can't believe I ate the whole thing." 5 years ago, he sold the comparatively little investment firm of Donaldson, Lufkin, and Jenrette to giant Equitable Life for $440 million and a promise that he would be permitted to continue running his operation. Last May, Equitable's board of directors put him in charge of the entire company after forcing out the previous CEO of the troubled Goliath. Dick, you said you'd expected to have fun. Equitable was described this past month as the sickest of the major insurance companies. Is that a fair comment?
Not at all.
Please tell us your side.
Look, this is a company we're managing $135 billion of assets. We're the second largest manager of assets of the U.S. We're managing $90 billion of pension funds. We must be doing something right.
Why is so much of the press suddenly ganging up on Equitable?
You've heard of a herd instinct. The Equitable is a tremendously strong company. We have $2 billion of capital on a statutory basis, which is very conservative accounting. If you put it on a GAAP basis, it's another $1 billion. If you compare that to S&Ls and banks, it's a very conservative ratio.
As you know,
I just really totally disagree with that characterization.
As you know,
everybody has a bad year now and then.
Some of the so-called consumer advocates in Washington say that what we saw with the S&Ls and the banks is about to be repeated in the insurance industry. Is there any validity to that criticism?
Absolutely not. As you know, I've spent 33 years on Wall Street calling on financial institutions. The life insurance industry, is without doubt the most conservatively managed industry that there has been. The investment philosophy of the life insurance companies, including the Equitable, is essentially very conservative. You've got 85% of your assets in top quality bonds, investment grade bonds, and mortgages. Where did everybody get the idea that all real estate is bad, that all mortgages are bad? Our properties are first class. We have had a very good investment yield over a period of years. It will be down this year, but we need to get our costs down. This is a period of opportunity.
Clearly, Your own board of directors was not happy this year with the progress of the company. What's the source of the trouble? Is it those guaranteed investment contracts?
That's true, Lou. There was a flawed contract. It goes back 8 or 9 years ago that did, in fact, have a mismatch of assets and liabilities and probably cost the company $1 billion. But is the glass half full or half empty? The ability of the Equitable to withstand that loss and remain a strong company and meet all its obligations and be competitive suggests to me that we've got a lot going for us. And this is creating an opportunity to do some things and cut costs that really are, turn a problem into an opportunity.
Millions of Americans of all degrees of financial sophistication hold life insurance policies. Yeah. They must be disturbed when they see the kind of stories you've just been objecting to. What would you say to those people tonight? I
would say that the stories are greatly overblown, and anyone is crazy if they cash in a policy thinking there's any more than a short period of time.
When can we expect to see Equitable clearly financially healthy?
I think let's come back a year and I'll give you a good report. I think things will be doing a lot better.
To what extent does your forecast depend on lower interest rates, for example?
Not very much, though I think we will have lower interest rates.
What do you expect on interest rates?
I think we'll see a year from now interest rates 100 basis points lower, probably than they are now. Certainly at least 50 basis points. That will help, but...
I can't let you get away without asking you about the industry in which you were such a pioneer, the stock industry. Wall Street's in a despondent mood. What do you see for its future?
It's been around for 200 years. It will continue to be. I think this is a great period of opportunity.
Will it continue to shrink as it has for 3 years?
Suppose it refreshes. You know, when you get a situation like this, you have to trim the sails now and then, and I think this is a period of opportunity right now. It's a healthy thing. You can't have every year up.
I have the opportunity to turn you over now to 3 distinguished panelists, starting with Bob Stovall.
Dick, this new tax increase that we're all going to have to cope with hits the insurance industry pretty hard. Could you explain to our viewers just what it's going to do to the insurance business?
The insurance industry took it on the nose in the recent budget battle. Something rather esoteric sounding called deferred acquisition costs, which is basically the commission we pay the salesman for the first year. In any other industry, it's deductible as an expense. Well, Congress has said we have to spread this commission over a period of years. It'll probably cost the life insurance industry about $1.6 billion of new taxes a year.
Every year?
No, in the first few years. It is a deferred thing. We'll get the deduction, but instead of being able to deduct the commission the first year, it'll have to be spread out over a number of years. So long term, it won't make any difference, but short term, it's a big hit. So we're subject to statutory accounting, which is very conservative, and you have to treat it as an expense, but you can't deduct it on your taxes.
Okay.
Dick, there was some information in the press this week that 57% of employees, when given an option by their employer savings plan or pension plan, choose a guaranteed insurance contract. How important do you think it is that those employees should look behind to see what insurance company is behind it and the rating of that insurance company?
It's important, but there are 2 things. When you buy an annuity, it's a long-term investment contract. You better not only ask what is the credit rating of the company, but what is its investment performance track record. I think that's one of the Equitable's great strengths. Our investment subs have had clearly the best and long-term investment track record in managing separate accounts that fund these annuities.
Dick, let me get to a more generic subject. I know you follow this. The savings rate of this nation is very, very low.
Appallingly low.
Right. What can be done to induce the savings rate higher so we'll have more capital?
Well, number one, I think the demographics will help a lot. I see the savings rate doubling or tripling over the next decade. But beyond that, I think some of the institutions like the New York Stock Exchange that Lou and I were discussing beforehand, my former colleague Bill Donaldson is the new chairman. The Stock Exchange has really not paid much focus on attracting the individual in, and there's a great opportunity for institutions to re-attract individuals to the market. You know, why shouldn't government bonds be traded on the New York Stock Exchange in small lots? Make it more popular. A lot of things can be done.
Tell us some more.
To attract more
Tell us
individuals.
some more that you think the industry should do to attract individual investors, because heaven knows individual investors are not being attracted right now.
It is, but Lou, they're not doing anything. I think the problem is the low savings rate. They're buying BMWs and Toyotas and things like that and houses, and I think they probably have been turned off by the volatility. But the fact is the stock market has been very good. If they haven't been lured by a 15 to 20% a year market appreciation, I don't know what more we can do to make it look attractive.
We're nearly out of time. You made a bold prediction. You said in a year, equity will be looking a lot healthier. What's going to turn it around?
We are biting the bullet this year. We've cut costs by nearly $200 million. It'll be expensive the first year. Look a lot better a year from now.
Thanks very much, Dick Jenrette. Thanks, too, to our panelists. Hope you'll be back with us again next week. Then my guest will be one of the rising young stars of Wall Street, Alan Bond, a money manager with a special gift for picking winners in today's tougher environment. We'll be asking him where he's finding those winners now and how he'll be investing his clients' money in the months ahead. I hope that will get a rise out of you. Meanwhile, this has been Wall Street Week. I'm Louis Rukeyser. Good night.
Wall Street Week with Louis Rukeyser has been made possible by the financial support of viewers like you. By the Travelers, insurance and related financial services working to provide financial peace of mind for over 40 million Americans. By Enron, providing natural gas which holds the promise for a cleaner world and a more energy-independent America. Enron Corp. And the Enron Foundation. And by Prudential Beach Securities. Rock solid. Market wise. For a printed transcript of this program, send $5 to Transcripts, Wall Street Week with Louis Rukeyser, Owings Mills, Maryland, 21117. That's $5 to Transcripts, Wall Street Week with Louis Rukeyser, Owings Mills, Maryland, 21117. Wall Street Week with Louis Rukeyser transcripts are also available to subscribers of the Dow Jones News Retrieval Service. Wall Street Week with Louis Rukeyser is produced by Maryland Public Television, which is solely responsible for its content.
The Chicago presentation of Wall Street Week is brought to you in part on behalf of Steinrow Mutual Funds, where a world of investment opportunities awaits you. Whether your investment goals are capital preservation, tax-free income, or long-term growth, the Steinrow family of commission-free mutual funds is ready to help.